Welcome everyone to today's session on housing finance reform, where we finally get the stone up the hill. For those of you who have engaged in housing finance reform now for years and years, we will know exactly what that means and why it's I think, a good analogy or metaphor. But we're very excited to have this session. This is something, especially for those who are in this field, it is something of tremendous importance to the American economy and also to individuals and families alike. We're going to talk today about housing finance reform and what it means and why it's so important both from a systemic standpoint, an industry standpoint, and from a consumer standpoint, because those really are the three pillars of what we need to do to have a housing finance system that works for all, that works for the safety and soundness of the system, that works for an industry that is called upon to operationalize housing and mortgage and access to credit so people can be homeowners, and then to consumers, who really are the heart of it because they are the homeowners, and from an individual and family perspective, it's shelter. After food, air, water, it's one of the key drivers of what life is all about. So first I want to introduce our panel. Thank you very much for being here in alphabetical order, and on the stage we have Bob Broeksmit. Bob is the president and CEO of the MBA. The MBA is one of the most important organizations in the housing and mortgage space, having a constituency that includes all lenders and servicers, and really it's the heart of the industry. And so the seat that Bob sits in is an incredibly important one. He's also as a leader of the industry, and really just not only in thought but in action as well. Bob has well over 30 years experience in the mortgage sector. You could not have gotten this job without that. Prior to the MBA, Bob was president and CEO of Treliant, which among other things brings advice and expert support across a wide range of issues to a wide range of clients. And before that, he held senior executive positions throughout the mortgage industry. And he's also served as chairman of the MBA ResBog, or the Residential Board of Governors, which again is a very important seat, and also is a member of the MBA Board of Directors. So, Bob, welcome.
Thank you, Eric.
Jeb Mason, I call one of the smartest guys in the room, and not in the bad kind of way, is a partner at the Cypress Group. And Jeb specializes in helping institutional investors and Fortune 500 businesses, startup enterprises, and others navigate risks and identify opportunities in today's public policy environment, with a particular focus or specialty in housing finance reform. It's not exclusive, but we all know him for that. And when the crisis hit, Jeb was actually Deputy Assistant Secretary of the Treasury and a policy advisor to Secretary Paulson. And before he left, Secretary Paulson bestowed upon Jeb a Distinguished Service Award. Jeb's also been an Associate Director for Strategic Initiatives at the White House, where he advised senior staff and cabinet members on policy initiatives, and was also a Department of Defense Fellow during 9/11, where we know the work that you did was also incredibly important for very different reasons than for what we sit here in housing today, but advising senior leaders at the Pentagon, White House, Homeland Security, and also even the Iraqi coalition. So thank you. And also, if you read Too Big to Fail, he's the handsome Texan. So there's a reference there. And Lisa Rice. Yeah, I toyed with doing it. I told you I would.
Brad Pitt, right?
Lisa is so happy to have Lisa here, and I continue to learn so much from Lisa and also other housing advocates in the room, Mike Calhoun and Nikita Bailey from Center for Responsible Lending. But Lisa is the president and CEO of the National Fair Housing Alliance, which is such a critical organization. It's the nation's only national civil rights agency solely dedicated to eliminating all forms of housing discrimination. The NFHA, or Fair Housing Alliance, is also the trade association for over 200 member organizations across the country that work to eliminate barriers in the housing markets and expand equal housing and lending opportunities, providing a range of programs, outreach. I mean, the work that you do is just so wide-ranging and with deep impact. Lisa's also a member of numerous advisory boards and councils, including the Leadership Conference, which is sort of the umbrella organization for all civil rights organizations, consumer advisory councils for J.P. Morgan, Quicken, the MBA. We were on Quicken together, and those are so important because they help industry organizations really stay abreast of and attuned to the needs of the consumer and how their activities impact the consumer. And so it's a very good form of outreach to get the consumer and advocate perspective into what industry is doing. But in any event, and many others as well. So again, thank you for being here. So to get started, again, we're going to talk about housing finance reform with a focus on the three prongs of it, from system, industry, and consumer. And so hopefully when you walk away today, you've got an idea about where we are and why we need this. But I want to canvass the audience. Who here feels that they have a comfort level with, or feel that they're very familiar with the current state of housing finance reform and what some of the issues are? Or, did you come here to learn a little more? All right, so what we'll do along the way, a lot of times we devolve into acronyms and other substantive points that we kind of bandy about as secondhand, in a secondhand way. It's sort of regular day speak for us, but we'll try and break down concepts which may be a little bit esoteric. So I want to start now with Jeb. If you can frame for us where we are in terms of from the crisis till now, what are we wrestling with from a systemic standpoint with respect to housing finance reform and why we need reform and what we're really talking about with it?
Sure. Look, fundamentally, we're still in a situation in which you have an implicit backstop of the taxpayers on two quasi-private companies. And so I think in its essence, what the political system is wrestling with is how to bring the implicit backstops to an end. The implicit backstops are the situation in which profits are privatized, basically, and losses are socialized, as we saw through the crisis. And that's basically a recipe for further boom, bust, and bailout, with pretty significant consequences for both taxpayers and consumers alike. And so what we want to try to effectuate through reform, I think in its essence, is have an explicit backstop such that there are going to be any backstops at all, and that backstop be behind an ample cushion of private capital, and ideally removed from the entities level and moved to the security level so that you have entities that ultimately can be allowed to fail without threatening to take down the entire primary market.
So in this case, what you're saying is that, and again, for the benefit of the audience, the mortgage-backed securities that are issued are supported by the government with a layer of private capital beforehand, so the taxpayer funds are not being called upon to make up for the losses. But if the entities go places they shouldn't go or become insolvent, we don't have to do another bailout like we did 10 years ago.
That's right. And ideally, that institutes an element of market discipline in the pricing of risk and ameliorates boom and bust cycles. And if we get it right, we have the opportunity, I think, to significantly de-risk consumers, taxpayers, and mortgage market participants as a whole, while expanding homeownership opportunities and wealth, and even ameliorate wealth inequality. Do it wrong, and you mess up the second largest financial market in the world with pretty significant consequences. And so it's a big deal still in Washington, 10 years after the crisis. And it's been called the great unfinished work of the crisis. I agree with that. The last thing I think I should say is that we as a country, you want to do all those things while I think we decided as a country preserving a broadly available 30-year fixed rate, fully prepayable mortgage. And so that's the challenge. And so nearly every proposal I think that's been out there, right, left, and center, says let's have an explicit guarantee, let's end the duopoly, let's have some sort of market utility function, and some sphere for private competition in the pricing of credit risk. The disagreements principally are just about exactly how to structure that and what's the sphere for private capital versus the public utility.
Break that down just for a moment in terms of the competition, especially in terms of Fannie Mae and Freddie Mac, and why they're so integral to the housing finance system and why they're a central feature of reform.
Yeah, look, one man's opinion of kind of why, in essence, we ultimately had to bail them out in the crisis is that the primary market, and Bob can probably speak to this better than I can, the primary market is so inextricably linked to the technology of the enterprises that the failure of either of them threatened to take down roughly 50% of the origination market. And so, much progress has been made in conservatorship to try to tease that out, and what was originally begun under DeMarco and continued under Watt was the building of something called the Common Securitization Platform, the CSP. And at least in some conceptions of reform, ideally the primary market would be tied into the CSP, the utility, which which would survive in any crisis, while a guarantor could be wound down should it take excessive risks. You know, to make that work, though, you need legislation to actually charter new guarantors, so that they get somebody else to buy the risk on the back end of the utility, in essence.
Okay. And by the way, as we talk, we're going to get to a concept that there are some reforms that can be accomplished administratively through the actions of certain agencies like the FHFA, the CFPB, other stakeholders that are government agencies. And there are some reforms that can only be accomplished congressionally. And that is a central point at issue in the housing finance reform dialogue. We wrote a paper in January, it's outside, on this very topic, but that actually comes into play critically. Like I said, we'll get to it in a few moments. But Bob, from your perspective, layering onto what Jeb said, from an industry perspective and really being at the forefront of so many voices throughout the industry with different incentives, different business models, where do you see the housing finance reform dialogue? Why does it matter to your constituents? What matters and what needs to be done in order for the system to be commercially viable, but not at the expense of consumers, that we'll talk about with Lisa in a moment?
Sure, thanks, Eric. And I think the thing that matters to our members and to the lenders is that it matters to consumers, because the consumers want and expect an affordable 30-year fixed-rate mortgage and 15-year fixed-rate mortgage. We have to remember there are also some products that let you get some equity a little more quickly. So it's not just 30-year fixed, but let's just call it fixed-rate mortgages through all economic cycles in all parts of the country. And if we don't have a strong and viable Fannie Mae, Freddie Mac, and competitors to them, then it's unclear how we would provide that for our borrowers in this country, whether they're buying a home or whether they're refinancing a home. So then when you get down to the positive thing is that over the 10 years of conservatorship, there have been ample ideas about how to do this. And as administrative reform through the Federal Housing Finance Agency that regulates Fannie and Freddie and the Federal Home Loan Banks, as that administrative reform has proceeded, and Jeb mentioned the Common Securitization Platform, they're launching the Uniform Mortgage-Backed Security in June, which means that there won't be a difference between how Fannie Mae and Freddie Mac securities perform. Well, I mean, it could be on how they perform, but how they're structured and the timing of the payments to investors and various esoteric things like that. But it'll be one uniform security. And the administrative reforms have ensured that there's not pricing that differs based on volume. So in the old days, before conservatorship, Fannie Mae and Freddie Mac might have a price for a very large lender that was better than a price for a smaller lender, despite the fact that the quality of the loan was either the same or could even have been better with the smaller lender. So that hasn't happened in the last several years, but it's been done by the conservator, by FHFA. So we want those reforms locked in, and Mark Calabria, who was recently sworn in to a 5-year term at the FHFA, has said as well publicly that he wants to lock in some of the reforms that have taken place. He then has a good deal of power as the conservator to make some administrative reforms beyond what's already been done. And the dance in Washington is going to be, can Director Calabria make some moves that make sense in terms of strengthening the GSEs and ultimately paving the way for legislation, which is required to, as Jeb mentioned, make the implicit guarantee explicit and paid for, and with private capital in front of it, and to create charters that would allow other entities to serve as guarantors and provide more competition, which we believe benefits consumers and borrowers. And so can Calabria make administrative moves to nudge Congress to act? Because I'm pretty sure that if you poll any representative or senator, they're not going to say one of my top 5 issues I hear about from my constituents is GSE reform. It's just not high on their list. So they need to be prodded, but they can't move too precipitously, or Congress could do something like pass a bill they did in the last session, which has since expired, that says the government can't sell any of its Fannie or Freddie shares without congressional approval. So that's the executive branch and legislative branch push and pull that we're seeing right now.
And I want to unpack one or two things there. Let's get to the crux for a moment of back to the need for housing finance reform. the status of, excuse me, the role of government versus private capital, and what that status is now on the what we call the agency government footprint, meaning loans or parts of the system that are backed by ultimately taxpayer money, versus what we really mean by private capital. And just to give a head to for people who don't know, Fannie Mae and Freddie Mac, the government-sponsored enterprises, constitute about 50% or are involved in 50% of the housing market, of the mortgage market. So virtually 1 out of every 2 loans is ultimately purchased by Fannie Mae and Freddie Mac, and there's a guarantee element of the securities that they issue that are backed by those loans. And when you layer on the government part of the footprint, so HUD entities, so the FHA and VA, you have a housing market where about 70%, give or take, 75% of all mortgages have a government backstop element. And this evolved out of the crisis. Right after the crisis, we were sometimes at 90 to 95%, and we've slowly gone down. What's the issue there with respect to, again, the role of government, the nature of the government support, and with respect to Fannie and Freddie, I want to get into in particular this notion of Fannie and Freddie as profit-seeking entities, operating as profit-seeking entities, but with the benefits of certain government protections and advantages that private capital doesn't have. So if we could talk just a bit about that before we get to the consumer part.
Sure. Let me just briefly state that FHA, which is a HUD program, has the full faith and credit guarantee of every loan, so the taxpayer's on the hook for every penny. And VA, which is of course a veteran's benefit and is between 10 and 15% of the market, lets veterans get into homes with no down payment. It actually performs quite well, but that also has a government guarantee. And then there's the USDA, the rural housing system, which is about 1% and of course serves rural communities and also has a government guarantee. Fannie Mae and Freddie Mac have an implicit government guarantee, which pretty clearly was made explicit, not legally, but practically, with a $254 billion line to the U.S. Treasury. So they each have $3 billion in capital, and then if they go through that, they have access to $254 billion more.
Right, and that was implemented after the crisis, right? As a consequence of the crisis, or
yes. And one other reform that I neglected to mention during the conservatorship has been that Fannie Mae and Freddie Mac are laying off a lot of that risk in what's called credit risk transfers to the private market. So there's actually a lot of private capital. If you think about private capital, what do we mean? Well, the borrower's down payment is private capital, right? Because the GSEs, Fannie and Freddie, don't make 100% loan-to-value loans. So there's a down payment. If there's less than 20% of a down payment, there's private mortgage insurance, which comes in and makes the lender whole for losses up to a certain point. And with these credit risk transfers, there's a lot of private investors that are actually coming in and saying, I'll buy that risk at a price that's economic for the GSEs so that they can still make loans at attractive rates. And so we have to be careful about how reform might move lending from one bucket to the next, because if you move lending from Fannie Mae and Freddie Mac into, say, FHA, the taxpayer's actually on the hook 100% for that, where with Fannie and Freddie, and we would look for whatever reform happens to codify the requirement to lay off risk the way they're doing now with these credit risk transfers. So it's a bit of a complicated answer because the government is involved, but in different ways in all these types of lending.
Yeah, Jeb.
So it might be helpful just that, like, a highly stylized model of the enterprises, in my view, is that they essentially are 3 things. You have a credit insurance business. On top of that, historically, you had what's called the portfolio business, which is more or less a hedge fund that sits on top of the insurance company and invests in MBS historically. And then thirdly, you have a bunch of technology and critical infrastructure and some of the systems that help the private market make loans to consumers. In conservatorship, a lot of progress has been made, I think, and there's almost unanimous consensus in Washington that the portfolio business ought to largely go away, except which the minimum amounts that's necessary to buy loans out of trust that are distressed. But there's also been great progress in de-risking the insurance company through the CRTs, the credit risk transfers that Bob mentioned. There's been major investments made with taxpayer backing in the technology and the systems of the enterprises and the things that they perform more or less as a utility for the market as a whole. And so, but all those reforms to date are at risk in the absence of legislation to codify that. And so that's a big part of the discussion in Washington, if that's helpful.
All right, so taking this together, and Lisa, excuse me, moving to you, we've got a system where, again, 10 years after the crisis, we do not have, we've had reforms, as Jeb mentioned and Bob mentioned, but they've been implemented in a way where they're not permanent and they haven't been legislated. We can't say that they're going to be lasting forms of or lasting elements of a new system going forward. And what we're trying to do is establish a housing finance system of the future that will serve generations to come. But we have talked a tremendous amount, and your day-to-day work is looking at part of the system that isn't working now and that really requires reform, with a particular focus on low to moderate income borrowers and minority home ownership, which is at lower levels than you would imagine in a system where the agencies, or where government agencies are at the heart of it. And what are the issues now that we're facing in your day-to-day work, and what are the elements that we need to change in order to have any kind of a viable system going forward, and that, without which we couldn't get any kind of reform, or there would certainly be resistance to it?
Well, thank you for the question, Eric, and it's a very critical issue, particularly for underserved communities, as you have laid out. The GSEs have never been a viable provider of credit, liquidity for underserved markets, and markets of color in particular. So, I can remember back in the 1990s going to meet with Jamie Gorelick and other leaders, both at Fannie Mae and Freddie Mac, not just at Fannie Mae, but sharing with them market penetration maps from cities in Ohio where I was working at the time, Toledo, Cleveland, Dayton, Cincinnati, Columbus, et cetera. And these market penetration maps that we would generate year after year after year showed that in predominantly communities of color, Fannie Mae and Freddie Mac were virtually purchasing no loans, not any. So their market penetration level in communities of color has always been very, very low. They really have not provided credit liquidity for this segment of the market. Now their response was, well, it's the primary lender's fault because they're not making loans to this market segmentation. They're not making the kinds of loans that we can purchase. The folks who are making loans to this segment of the market are your subprime lenders, or your finance lenders, or seller finance lenders, et cetera. And that primarily is a function of this systemic challenge that we have. And that is that the housing and finance market was designed to exclude borrowers of color and to primarily serve white consumers. So the housing finance system that we have is very much stemmed and rooted in market reforms that took place after another market crash, right? The Great Recession. And during the Great Recession and afterward, we put in this sort of model. That's when Fannie Mae was established. That's when the HOLC was established. That's when FHA was established. But if you go back and look at the underwriting guidelines, if you look at the guidelines for all of those programs, what you will see is that the policies were very much racialized. I mean, it's even shocking for us to read this language today, but it is very clear in those underwriting guidelines. They say things like, you have to work to creating segregated communities. You have to have racially homogeneous communities. They describe borrowers of color as being hazardous. In fact, the HOLC created and the FHA utilized a systemized fashion, a systemized process and model for redlining communities of color. They required the use of what were called racially restrictive covenants. So the system, what it did back in the 1930s was it sort of infused, it fused the association between race and risk in our financial markets, right? If you were a borrower of color, you were inherently risky. Right? And what we have done over the decades is we have built new technologies, but as we have onboarded new technologies, we didn't design the technology to correct for that discrimination, that discriminatory model. What we did was we built new technologies that would just replace a human functionality with a computerized functionality. And what we have done is we've traded human bias for algorithmic bias or technological bias. And so our risk-based pricing systems, our automated underwriting systems, they perpetuate the discrimination that is replete throughout our housing and finance markets. In fact, Berkeley University just did a major study in which they only looked at fintech lenders who originated GSE mortgages.
So these GSEs are Fannie and Freddie.
Fannie and Freddie. So this is a homogenized pool of loans. And what they did, so these are fintech firms that are using an algorithmic system to both determine eligibility and the price. And what they found was that the algorithms themselves were discriminating against borrowers of color because the algorithms were picking up that borrowers of color were shopping less for credit, but also borrowers of color over and over again were paying for their credit, for their credit cards, for their auto loans, et cetera, were paying a rate that was higher than their commensurate level of risk. And the algorithm is tuned, it's keyed to maximize and optimize profits, right? So how do you optimize profits? Well, if a borrower pays more historically, they'll pay more presently and futuristically. And that's how the algorithms are designed. So part of the challenge that we face with the GSEs is that they have not, when they onboarded technology and designed technology, they did not understand how their own agency, how Fannie Mae historically discriminated against these markets. And they didn't design the technology to remove the discriminatory element. They designed the technology to just perpetuate the discriminatory outcomes going forward. And so that's one of the reasons why the African American homeownership rate in particular is so abysmally low. The African American homeownership rate today is where it was 50 years ago when we passed the Federal Fair Housing Act. So we saw a small uptick in homeownership rate for African Americans, but because these consumers were hyper targeted for subprime loans, they lost houses, they experienced foreclosure at a much higher clip, and after the crisis has ended, they haven't been able to come back, primarily because the system isn't designed to serve them. And so let me just make one more comment, two more comments. One is that one of the other things to my mind, and this is my opinion, that the GSEs have done is they've stymied competition in the marketplace, right? And that restriction of competition, in that restriction of competition, one of the things that they've been doing is picking winners and losers, both on the industry side and on the consumer side, right? And that that's a systemic issue that needs to be addressed. And then the last thing I'll say is that we still have just plain old discrimination in the lending markets, right? So when borrowers of color go to access credit, they still experience discrimination. We just finished a very in-depth investigation of auto lenders, auto finance companies. And what we found with these auto dealers is that they were actively discriminating against consumers of color. I'll give you two examples. One, we found that borrowers who were white, consumers who were white, the auto lenders would illegally give them discounts for things that they didn't qualify for For example, if you're a teacher or a firefighter, you would get a certain discount. And these auto dealers would lie and say that their white consumers were either a teacher or a firefighter or a police officer to grant them this financial discount. They never did anything like that for our consumers of color. Shouldn't have done it for anybody. That's just one of the ways that they were perpetuating discrimination. The second is that they were consciously discriminating, using their relationships with the lenders in their orbit. And so in one instance, a auto dealer told our white tester and pointed to the black tester who was in the facility. He said, "Do you see that woman there? She has a FICO score that's 50 points higher than yours, but I'm still going to give you the better deal." So we still have conscientious discrimination that is occurring in the marketplace, that is stymieing, that is limiting and prohibiting access to credit.
So I want to pick up on two things you said and then turn to Jeb and Bob on those points for a second. But we've talked so much about this. It's projected in the next decade or two, over 50% of new household formations will be minority borrowers, right? Whether it's black homeowners, Latino, Asian. And so to have a system where it's so many people, when they think about discrimination, they think about the overt discrimination, right? You're black, I don't want to lend to you because I'm racist. But there's so much more embedded in the system, like you said, whether it's because of whether it's structural or historical. And one of the challenges, how do you root that out so that we do have actual fair housing, not just against overt or to combat overt discrimination, but also systemic. But the way that it gets carried through into the system, you mentioned competition and why it stymies. That goes to one key point about the GSEs, about Fannie and Freddie, is the duopoly. We always talk about a Fannie-Freddie duopoly and why that matters so much and why that lies at the heart of reform. Jeb and Bob, if you want to talk about what that really means, why we need to address it, how it stymies competition, and what are the advantages it might bring to the system, things that we might want to preserve, but why it also is damaging to the system, to consumers, to lenders, to the system at large. If you can pick up on that a bit, that would be great.
Sure, I'll start. Perversely, maybe, a duopoly, which one would think of as almost no competition, and they can behave themselves and get a nice margin and not worry too much about market share, actually does provide competitive pressure that's important to the consumer and to lenders. And it's important that the competition, especially if the government guarantee becomes explicit, but even in its current form, that the competition not occur on credit terms, because we don't want the government guarantee being placed on loans that are too aggressive in terms of credit terms, but technology and innovation and service to lenders and in turn borrowers is something that varies between the two GSEs, and believe it or not, there is competition in a duopoly. So early on, some of the reform ideas were, well, let's just combine them. Who needs two? And we actually believe there should be two or more. And the MBA's long-held position has been two or more, which simply means retain Fannie Mae and Freddie Mac, or whatever they'll be called after they become fully private companies again, after they're reformed, but have a mechanism for other providers of capital to come into the system. And the FHFA has proposed a rule about how much capital would be required for that. It doesn't apply to the GSEs while they're in conservatorship, but once they exit, and that would apply to any other guarantor. So that's an important step, we think, so that private capital can determine whether coming up with that much capital is reasonable and will give them a reasonable return in what is a very highly regulated industry, and which we advocate will continue to be highly regulated. So that's one point. I'm sure Jeb has others.
Yeah, I try to tie it a little bit to what Lisa was talking about. I mean, I think one of the enormous opportunities of reform is that look, if you want to think about it historically, I think the implicit guarantee is really, it creates, I think, what a lot of people view as sort of negative competition or excessive competition. FHFA is trying to address that in part through the creation of the UMBS.
Explain that a bit.
Well, it creates a race to the bottom on credit terms,
which we saw
if it's not managed properly, right? And when they don't have to hold adequate capital, and when their capital requirements are highly pro-cyclical, it exacerbates this. So you think about like the typical credit cycle, which I think is to some degree endemic to capitalism, but but I think we can lean against the cycles and boom and bust better than we are. But typically you start out post-recession making loans to the highest credit quality borrowers, often the people that already have a lot of wealth. Slowly but surely the credit box expands, and then you finally get to the communities of color, other first-time home buyers, people that you ostensibly ought to be the object of policy to the extent we're trying to help people get into home ownership. Oftentimes, the most marginal borrower isn't getting into a home until the housing market is already back into bubble territory. So house prices are exceeding, some sort of fundamental notion of value, such that a homeowner that takes 3% down or 5% down on a home mortgage probably is their life savings in many instances, and plops it down on a mortgage that's already in a house that's already 20% overvalued. Like, you're not enhancing their wealth, you're destroying it. If they have any income disruption during the downturn, right? Some people will survive and get lucky and still see wealth accumulation, but you're basically destroying wealth for a while, and it exacerbates, I think, the cycle of inequality in essence in housing. And so I think one of the opportunities of reform is that you actually can break that to some degree, partly by having countercyclical capital requirements leaning against the booms and busts. Now, the opportunity there is that when the market turns down and when house prices are relatively inexpensive, arguably you should be able to reduce your G fees, the guarantee fees, and you should be able to help more marginal homeowners get into homes and benefit from all the house price appreciation and the subsequent run-up. The flip side of that people don't like to talk about as much is that it also means that you can't, at some point you got to tap the brakes. You got to be willing to lean against the curve, and when house prices start to look really inflated, and let's look back at the sort of heterogeneity of mortgage credit risk. I mean, Bob mentioned earlier that the political system wants to offer loans at the same price across the country, but the truth is we had a global financial crisis when you really had home prices that got really out of whack in basically 4 states, Florida, Nevada, California, and Arizona. And so you've got to be willing, I think the flip side of sort of countercyclical capital is you've got to be willing to tap the brakes and say, look, no one should be forced to buy a loan by the government in Nevada in 2006 because things were 50% overvalued. And so,
or at least not forced at a certain high LTV. I mean,
Right.
there's
That's
ways
right.
to calm things down without pulling out of a market completely.
So there's a lot of opportunity there, and I also think, look, there's an opportunity too to sort of reframe the way we think about, housing subsidy, for lack of a better word. Historically we've been subsidizing ever more leverage, and Bob, you might want to cover yours, but I mean that benefits the lenders, but it's not necessarily beneficial to the consumer. And I think we need to have a conversation in the country about how, if we're going to subsidize, how can we subsidize equity and equity building that can actually ameliorate wealth inequality. I think you need a discussion about new products. You need discussion about own option leases. You need discussion about savings match programs. You need these kinds of ideas, I think, can help people get into homes, have a sufficient equity cushion that they can sustain themselves through the cycle, can live through an income disruption of some short duration, and continue building wealth in their homes, and ultimately have more stable communities as a result.
And Eric, let me just make one point about that. The MBA is a organization with single-family lenders as well as multifamily lenders, which facilitate rental homes. And we are not saying that every American ought to be a homeowner at a given point in time, or ever, really. But the GSEs also buy a lot of multifamily loans that enable affordable rentals. So I agree with Jeb that there are things that should be done that encourage people to build their savings and be able to make a down payment and have some equity. But in the meantime, they can benefit from the government's guarantees with Fannie Mae and Freddie Mac or whatever successor entities they'll be via the multifamily program and affordable rentals.
Yeah, because
If I can just pick up on a point that Jeb made about product development and innovation, that's something that we really haven't seen the GSEs do a lot of, even though they've been strongly encouraged to do so. They have a lot of data that they're deeming as proprietary data. I argue that it's our data because we're the taxpayers. And at least while they're in conservatorship, it's our data. But they haven't really made that data available, right, to the public so that we could develop innovative products that would better serve all market segments, and that's a huge failing. The other thing is they haven't really adopted unless forced to do so, and I have to give credit to Freddie Mac who did do this. But they were huge holders of REO, right?
Real estate, that's
real
loans that have been
estate
foreclosed
on properties, and these are properties that have been foreclosed on, and then the GSEs have taken these properties back. And I would argue that in the aftermath of the crisis, they did not handle their REO inventory in a way that would really facilitate the sale of those foreclosed properties to middle income, to everyday Americans. They handled their program in a way that best facilitated the transfer of those properties to investors, and in many cases, very large corporate investors. And so they really stymied the market in that respect as well.
So I want to move on to another topic, but just to close this up, I mean, one of the key points here, and I don't think we dove into it too much, is this duopoly. You've got Fannie and Freddie operating with respect to 50% of the market in a way that is virtually unchallenged within their footprint. There's some challenge on the margins, but at the end of the day, you can't really compete in the space where loans are eligible for Fannie Mae and Freddie Mac purchase. It's very, very difficult for any other entity to come in. And they do have a wealth and treasure trove of data and other tools. They've had virtually an unlimited ability to spend on technology, which on the one hand is a good thing, but on the other hand, back to Lisa's point about picking winners and losers, it can also stymie technological developments. So think of VHS and Betamax. They're choosing VHS or Betamax. There could be 4 or 5 other technologies that could find their way to the light that might be better, but not if they're not selected by the GSEs. So the question is, right, they're providing a service, and so in the absence of a GSE or Fannie or Freddie, or if you shrink their footprint, who's going to come in and provide mortgage credit to consumers that they were responsible for, within their footprint, if you undertake that action? So the question there is, if we do anything in the way of reform that shifts the footprint of the different players, agency, government, private capital, or what we call non-agency, where do those loans move in the shift? And are other parts of the system ready to absorb that new market share? And can they do it safely and soundly from a systemic standpoint in a way that lenders and other participants in the industry are able to operationalize in a commercially viable manner? And then also from a consumer standpoint in a way that ensures all individuals and families have access to mortgage credit if they're credit worthy and can sustain home ownership, or to adequate rental property as well. Because at the end of the day, what you want is shelter that every individual or family can afford, whether it's rental or whether it's ownership. Obviously, one of the key points of ownership is that you do get to build up equity, and a whole other topic is differences in wealth between 1, homeowners and renters, and 2, across the different races. I mean, that's a day-long symposium in itself. But I want to turn right now to where we stand, take about 10 minutes, and then I want to open it up to some questions. There was a White House memo that came out, and I think it's a very different stage than we've been at any time since the crisis, in which I think there will be action. The question is what part administrative, what part legislative, and why it's so different now, what we can expect to see, and will it lead to lasting reform, or are we still going to be waiting for Godot on that?
So I think it's a really interesting point in time, as I mentioned before, about what the executive branch can do and what the legislative branch has to do. And Director Calabria, who's been in for 2 weeks or whatever it is emphasizing 2 things. One is it's a 5-year term. I've got some time. And the other is I'm not going to let any moss grow under my feet. So they sound contradictory, but I think what he's saying is that he understands that housing and housing finance are such a critical part of the U.S. economy. And while, of course, he doesn't say it explicitly, he also understands that there's an election next year, and having a Trump appointee screw up the housing market's probably not a great look. So he is going to put things in place, but understands that there is a timeline that goes in years and not months for how we get this thing in a better place by the time his 5-year term is up. So, but and this ties in a little bit to your question about will private capital, what will replace the capital source that the GSEs are providing today for some part of the market if the GSE footprint shrinks. There's all kinds of private capital that's ready and willing to invest in mortgages, whether it's bank balance sheets, whether it's real estate investment trusts, whether it's insurance companies or fixed income investors. But it's been held back by uncertainties about the risks inherent in that business. And these investors remember what happened after the Great Recession and the tremendous losses that they took. And there's a lot of steps that have been taken to improve it, but there are still obstacles, and I won't get into the details, but there are ways in which the government policies favor Fannie Mae and Freddie Mac, for instance, over these private capital sources. But we're trying to attack them one by one and make the water safe for these this private capital to come back in. Our only advice to Director Calabria is don't move so quickly that you think private capital is going to come in and then it doesn't, and then it affects home buyers and people who want to refinance their loans. And so that indicates an approach that might be using pricing rather than outright prohibitions to steer more business into private capital sources versus the government guarantee.
Okay. Jeb?
So look, I think the FHFA director, I think, has extraordinary power. I mean, truly extraordinary power. As a single individual, I think you can make a case, maybe as a single individual, can have a greater impact on the American economy than almost anybody, save maybe the Fed chairman.
Yeah, and
So,
I just want to point out, it's when we talk housing and mortgage, you're talking about 15%, give or take, of the American economy.
that's right.
Right.
And moreover, there's the authorities he has as regulator and as conservator. There are additional authorities that Treasury has, in essence, as the provider, the exclusive provider of taxpayer of capital to the enterprises, without which they would cease to be going concern. So there's something called what we used to call the keep well agreements, the preferred stock purchase agreements, and there's active discussion, and Calabria has already sort of telegraphed that he's willing to sort of initiate a discussion later this fall about amending the keep well agreements to, for instance, start retaining capital on balance sheet. One of the challenges with that is that ultimately what you're talking about is a wealth transfer from taxpayers to the balance sheets of the enterprises. So it seems perfectly reasonable that in exchange for that, if they ultimately go down that path, that taxpayers would demand that they have certain restrictions in place on the GSE's activities to reduce the risk that taxpayer contributed capital is consumed in risky activities. And so there's almost no limit to what they could conceivably write into these bilateral contracts between Treasury and GSEs. So the world is it's really a blank slate. I think the places there, I think they are sensitive to not creating a dramatic credit contraction in the economy, as any administration would be. But they do want to gradually, I think, move the enterprises from, say, the 50% market shares they have today, probably down to something closer to like 30%. And they can start at the edges around certain product features. Certainly, there's a lot of active discussion in Washington about 97 LTV loans. There's discussion about loans that are above 43 DTI and what are covered by the QM patch, which we can go down that rabbit hole in a minute. There's talk about ending investor loans and creating opportunities for the private label market to sort of step into that space. But another way they can also sort of de-risk the taxpayers is also through an expanded use of credit risk transfer. For instance, they could, today's the charter requirements for the GSEs is that any loan that's above 80 LTV has private credit enhancement, oftentimes from private mortgage insurers, but also there are other forms. They could write into the PSPAs that be 70% or 65% or 60%. In which case you'd be achieving what a lot of the proposals for reform have set out to do, which is to put the taxpayer guarantee in a very risk remote position, sort of catastrophic position. So they have a lot of tools available to them. I think the smart thing is that they would move gradually, but there's a lot of levers and dials you can play with.
Okay.
The thing I'm most concerned about, and I'll be really brief, is what the memo doesn't include, what it leaves out. One of the things that it does not include is anything about the consumer. There's no language in the memo that is consumer-centric or consumer-focused, and that really concerns me because we've learned from one of the lessons learned from the crisis is that when industry doesn't direct its focus to what is best for the consumer, then we get into some very, very dangerous territory, because the industry does what's best for it and its profit generations, and that's not always the safest approach and most sound approach to take. The other thing I will add is that the memo calls for a lot of coordination between the different agencies, including HUD, the Department of Housing and Urban Development, and FHA. And I'm very concerned about sort of the lack of trying to be politically correct. I'm concerned about the capability and the ability. The FHA is very short-staffed. They're operating on bones as it is, and they need a lot of sort of capital, intellectual capital, to be able to coordinate, act in a coordinated fashion to achieve the goals in the memo.
All right. Well, actually, by the way, the White House memo, for those who don't know, last month, the National Economic Council issued a memo on behalf of the president, and it calls for a plan from, and this is for the first time really since the crisis, this is what I meant before by having an action plan. It calls for a plan from Treasury, it calls for a plan from HUD about what to do within their respective universes with respect to reforms. And the two plans will go to the National Economic Council, who will synthesize one overall comprehensive plan with collaboration between HUD and Treasury and other stakeholders in the government, like the FHFA, the FHA, and the like.
And can I also add the fact that the memo talks about coordinating with the Department of Treasury and completely excludes CDFI, or any mentions of CDFIs concerns me as well.
Yeah, see the
Community Development Financial Institutions.
Right, which help to bring credit to a lot of the underserved markets. And so ultimately that plan that comes out will contain the proposed, well, really not proposed, mandated administrative reforms, what the FHFA is going to do, what HUD is going to do, and the other agencies as well. And it will identify what areas they need Congress to act on, where they're asking Congress to act. Congress at that time can decide to go along with the plan and implement. You'll have people who support the plan, you'll have opponents, but again, after 11 or 12 years, we know that no plan is going to come out that's going to be universally accepted, but what we want is one that's functional and works and protects consumers, industry, and the system alike. But if Congress doesn't act, or if it acts to do something different, what will be the result then? I mean, we may be dealing with this 5-10 years down the road, depending on how that plays out. But I want to take 30 seconds apiece and then open up to questions. What's the one piece of must-have reform? What's a non-starter if it's not there? What could be the most impactful? What's the lightning round answer here?
Explicit guarantee ability for additional competitors before the GSEs are released from conservatorship.
Okay.
If you're serious about reform, you've got to end what's called the QM patch. We didn't have time to go into what that is here, but
do that on the question.
you got to end the QM patch, and I'll be a little provocative and say I would separate the capital structure of the CSP from the capital structure of the enterprises.
Have to overhaul the system for automating, for determining and assessing the eligibility criteria for consumers, as well as the pricing mechanism for consumers.
Right. By the way, after this session, if anyone has questions, either here at the conference or afterwards, please feel free to reach out on something like the QM patch. We can talk for 24 hours and not even get to the heart of it, and we enjoy doing that. It's a sickness, but it's a sickness we own and love. So, all right, well, look, thank you for that. And by the way, also, Lisa, another part of this, it does touch on, and Jeb, with respect to LTV and DTI, that's the LTV, the loan-to-value ratio, the amount of equity that someone has in the property, and DTI, debt to income, the amount of their income that they use to spend on housing. We always know we're bumping up against those tensions. Do you have enough equity in the property so that you have an incentive to stay? Are you spending too much of your income so that the credit is not sustainable? I mean, ultimately, those are the guidelines within which we have to operate to make sure that we don't return to 2008. So let me stop there and see if there's any questions from the audience on these or any other topics.
Just curious if foreign private.
Oh, sorry, the microphone, please. Yeah.
Yeah, hi, thank you. Just curious if foreign private capital has ever been a factor, and if so, what kind?
It absolutely is a factor. I mean, I think one of the objectives of reform, and one of the reasons you want an explicit guarantee on the MBS, is that the foreign investors in particular strongly favor Ginnie Mae securities today, which have full faith and credit guarantees that enterprises do not. And so one of the opportunities that exists with actually passing legislation and creating that full faith and credit wrap for the enterprise's issuance is that foreign investors will be able to play a much more substantial role that should enhance liquidity across the board for the securities, and ultimately make more mortgages available at lower cost to consumers in the U.S.
But we also have to recognize that we have to build guardrails, because what happened in the lead up to the crisis is that capital was sort of driving where the industry was going, right? And if investors were willing to pay more for hybrid option mortgages, that's what was sort of directing the market and navigating people to originate more of those exploding arms that were not sustainable for consumers. So I very much agree with you, Jeb, but I think that we need to build guardrails into the system so that we're protecting both our system, our industry, and our consumers.
By the way, I want to point out also, two of my fellows here, Mike Stegman and Ted Tozer, our third one, Phil Swagel, couldn't make it, but Ted ran Ginnie Mae from 2010 to 2017 and had a tremendous amount of experience dealing with foreign investors. The explicit guarantee, for those who don't know, that's where the government will come in and guarantee losses on the securities. Implicit means the government wasn't bound, but as we saw in the crisis, they did. That's a little bit more shakier going forward, because people are not so sure that the government will come in to bail out losses in the future if we don't have an explicit guarantee. But maybe talk to Ted afterwards, because with respect to foreign investors, he's got some great stories and very compelling information and perspective on that, especially during his tenure at Ginnie Mae. Okay. Yeah.
So Lisa made a really good point with regards to when the market did, in 2008 did crash. The Fannie and Freddie toxic loans, or whatever they had put into REO, were very difficult to acquire for people of middle income investment categories, however you want to call it. So at that point, I was somebody who was, really looking at that, and had actually a multitude of different minority groups that were investing in, trying to invest in that, and we're trying to get together to kind of buy some of those loans, and it was nearly impossible to get hold of anybody in any of the organizations. So I'd like to know what's being done to address what she was talking about. So, even now, future, whatever, people can take advantage of, acquiring those.
Well, that goes back to my point earlier about the fact that the GSEs have an incredible amount of power, and they can pick winners and losers in the marketplace. I mean, in the aftermath of the foreclosure crisis, when the GSEs decided to go to a national model for handling their REO inventory, put a lot of minority businesses literally out of business, minority-owned businesses out of business. And it was because the GSE selected who their new national vendor was going to be, and was not developing policies that were designed to build inclusivity into their model. We were effectively able to work with Freddie Mac to get Freddie Mac to change and redesign its system so that it went back to a more regionalized approach, which turned out to be much better for communities, because when you looked at how Freddie Mac was maintaining and managing its REO inventory, those homes were in much better condition than Fannie Mae's homes. We ultimately had to sue Fannie Mae over how it was managing its REO division. But I do think that going forward, And the FHFA has a lot of administrative authority to address these kinds of issues as well, in terms of how Fannie and Freddie are operating their bulk sale programs and things like that. So the administrative power that the FHA has today is something that can be used to impact the kinds of things that you're talking about.
Yeah.
It's just a matter of whether or not we can get that on Director Calabria's on his mind.
But you asked if what's being done, and unfortunately it's not great news, I think, is what Lisa's saying, and maybe we're all saying. So far, it's not obvious that there's been a lot of action taken. I think what I alluded to earlier is, I do think you can put in, there's a lot of discussion about countercyclical capital requirements. I think that would help a lot. The next time there's a dip, my hope is that a lot of creditworthy homeowners end up able to buy houses at fire sale prices instead of them being sold to the Blackstones of the world. I got nothing against what those folks did. They put a floor in the market when there wasn't another buyer, but it could have been handled differently, and you could have created a ton more homeowners that had the benefit of a whole lot of house price appreciation, a lot more household wealth now, and the ability to sustain homeownership for the long run. That would be a benefit for the industry as well as those consumers, and I think for the taxpayers too, and that you'd have a more stable housing market going forward.
I would just caution that it takes a little courage to buy at the bottom of the market because you don't know if it's the bottom of the market yet. So I agree in principle, but when people at the backyard barbecue are all talking about how things are going down, 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 saying, but I can still get a loan from Fannie Mae or Freddie Mac, so I'm going to jump in. I agree they should have the opportunity, but there's a little bit of buyer psychology at work there too.
Yeah, that's right.
Yeah, absolutely. But we have real world practical experience with this, right? There were many families who wanted to buy at the bottom of the market and who recognized, that the market is going to return, but they systemically were precluded from being able to do that because of the way that Fannie and Freddie executed those,
and the HUD
those
sales
platforms.
as well. Yeah,
And sales as well. Exactly, FHA as well.
Yeah, and operationally, what you saw was these big bulk packages going out, whether they were of real estate owned or non-performing loans, which ultimately could turn into that if you could modify them. And so they would sell, and they still do sell these giant packages out, which does eat into what might be available. But ultimately, what it leads to investors like you, if you're looking to purchase, they've got to get it from the individual servicers, right, on a loan-by-loan basis. But anyway, look, I think we've reached our time. It's 12:15. Thank you all for coming. Again, if you do want to talk more about this either today or going forward, please feel free to reach out. Again, when it comes to a large part of our economy, and more importantly, or just as importantly, individuals and families, that's why this matters, and that's why we've set up the Housing Finance Program at Milken to try and work with government and industry stakeholders and consumer advocates across the board to try and get it right so that we have a working housing finance system for the country and for its citizens. So thank you very much. We appreciate it. And thank you, panelists.